Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Hi, the Indian hospital industry has seen a ramp up in private equity investments with deals worth over 27,000 crores in the last 2 years as per ICRA. The hospital stocks over the last few years has given returns between 120% and 650%, making it one of the best performing subsectors in the healthcare space. This was driven by rising occupancies, rising RPOPs due to rationalizing patient mix, rationalizing bed mix, and also performing higher end complex surgeries. To know more about the hospital sector, come join us for our True Blue webinar on 23rd March 11 a.m. Thank you.
The selling spree continues. Promoter selling has been going on unabated. We just saw a block sale in TCS by Tata Sons. We are seeing another sale in Birla Sun Life Asset Management Company by their promoter entities, but that promoter selling is mainly to comply with the listing regulations where they need to bring the promoter holding to 75%. It was something they agreed to at the time of the IPO and they have to do it. But we are still seeing a lot of promoters being more than willing to sell their shares at the prevailing valuations. I've seen investors say that they would never sell their shares in a Tata Group company, and especially so with TCS because it is the crown jewel of their group. But when the promoter themselves come forward to sell 0.6%, then it kind of shakes the market up. Because when a promoter sells, we think that it is their stance on the prevailing valuation. It's a kind of an investment stance taken by a promoter and a directional call on valuations. And we are seeing this in multiple companies, not just one group or one company. Essentially, promoters think it makes a lot of sense to take money out of their companies now and set it aside. The feeling is that the prevailing valuations may not be sustainable over the medium term or long term, which means that keeping some liquidity is like keeping powder dry, and promoters prefer that to remaining investor. Now, look at how we are looking at investment in the very same companies, and investors are simply unwilling to sell their shares in most companies, even after promoters sell. We are worrying that if we sell, you will not get your shares back. Now, contrast this to what the promoter is thinking. The promoter thinks that if he doesn't sell now, he may not get another opportunity like this to sell. Now, that's as contrasting as chalk and cheese. It's so divergent. So, investors seem to be more bullish on companies than the promoters of those companies. This is rather unusual, and I think this is mainly attributable to the fear of missing out, because if you sell, you are worried that you may not be able to buy back those shares. You worry that if you sell, the shares will be gone forever, which means the price will go up from here and you would not be mentally ready to buy them at a higher price. So, investors want to only sell when they feel sure and certain that the prices can go down. But they are not sure and certain the prices can go down even at the prevailing elevated valuations. That is clearly because how investors are perceiving liquidity is different from how promoters are perceiving liquidity. Promoters see liquidity as an opportunity to take money from the capital market. Investors see liquidity as something that will take away their shares and make them inaccessible forever. So, you worry that if you sell now, the liquidity will suck your shares away and it will go up and you will never be able to buy them back. Now, this contrast clearly has to be settled one way or the other. Only one of the two entities can be right, not all. In the near term, it remains to be seen who is right. Is it the promoters who are willing to sell or the investors who are not willing to sell anything. I think in this, the key driver is liquidity, because liquidity means different things to different people. For a promoter, it means ability to monetize his shares. But for a retail investor or a fund manager, it means a threat to deploying fresh flows in their products. A compulsion to invest gets created because of the liquidity, and that compulsion makes people invest even at valuations which they don't agree with. So one has to handle these compulsions correctly. You cannot have an emotional view of things. You need to be very, very cautious in decision making and deployment. And you need to think more like you are the promoter of the company, because in the present context, promoters seem to be thinking more sensibly than their investors. Thank you for watching this video.